Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 1277A, and today's date is May 11th, 2017, and the title of the episode is, When the System Comes Down, It Will Not Be a Smooth Landing. Let's get into the economic collapse financial news. Now, what we've been seeing out in the corporate media is complete chaos, and this is exactly what Trump and his people that are working to basically take back the United States, this is exactly what they want. And they need to do this. They need to create chaos. Because remember, the corporate media is the mouthpiece to the deep state. And while they're worried about all these ridiculous things, Trump right now is working in the background. And what I noticed is that the central bank, the Fed, where they're saying they're going to be raising rates, well, they're going to be raising rates up into a certain point until they can trigger the economy coming down, and then they're going to start saying that they have to lower the rates. And they'll make some type of an excuse why they need to do that. But what I noticed already is that things might have been triggered already. And we've been following the economy for a very long time, and we've been watching it deteriorate every single day. We've been pointing things out, and we've been looking at all these different things, and it has not gotten better. It has actually gotten worse, and especially with retail. Now, retail is the core, one of the cores right now of the United States for this economy to work, because 70% is spending of the American people. Now, yes, healthcare is included in this, but retail is a very big chunk of it. And retail is dying right now. Macy's right now, well, their earnings have come in. It doesn't look good. They are down negative 4.6%, below the negative 3.5% they thought they were going to hit. So Macy's right now is going to be closing another 100 stores. And this is not going to be the only retailer that is having this problem. Like, according to FactSet, we're expecting earnings to come out from many different retailers, and what they're looking at, it doesn't look good. They're looking at drug retail, it's like negative 1.1. They're looking at specialty stores, negative 3.7%. They're looking at apparel retail, negative 6.1%. And it goes on and on and on. And we can see, yes, they're going to come out, the corporate media, I can tell you this right now, they're going to come out and tell you how great internet sales are. Now, internet sales, as we know, that makes up 8.63% of total retail sales. It is a growing industry. It's just beginning. And yes, it's going to increase as it grows. And they're going to say internet direct marketing retail, well, that's up 20%. But it only makes up 8% of total retail. But they're not going to tell you that part. They're going to play on the part where they're going to say it's up, 15%, whatever the actual numbers that come out are. That's what they're going to tell you. These are estimated numbers. And we can see most of the retail industry is in the negative territory. And it doesn't look good at all. Now, we've talked about the auto loan industry, the car industry, and we've been talking about this subprime 2.0 bubble. And people say, well, the auto industry is nothing like the housing bubble, and that won't affect the economy whatsoever. Well, it doesn't have to do that much to affect the economy, because what we're seeing right now is that the auto loan industry is increasingly looking like the subprime 2.0, the needle that will pop the credit bubble. All it has to do is pop it, and the rest, all of it comes down. Now, since 2009, roughly 1/3 of all new auto loans have been subprime. That in of itself is pretty darn bad. But we are now discovering something very, very interesting in the industry. The industry in general has a problem with fraud, just like the housing bubble. Remember, it was fraud when they put together these subprime securities and said these are AAA rated. Well, this is what's happening in the auto industry. Remember, the real housing crisis was when the contagion spread from the subprime mortgages into the prime space. And it looks like we're doing the same exact thing, but this time with the auto industry. As many as 1% of U.S. car loan applications include some type of material misrepresentation. Executives and data analytics firm Point Predictive estimated, based on reports from banks, finance companies, and others, lenders' losses from deception may double this year to $6 billion from 2015. So I am not saying that the auto loan debacle will be the main crisis. What I am saying is that the auto loans will be the needle that triggers the crisis, that will get things rolling. And this will spread. And believe me, this is not the only thing. Because remember, since 2009, the Fed has created massive bubbles in debt securities, municipal bonds, corporate bonds, mortgages, consumer credit debt, auto loans. They've done it in all these areas. We have the housing bubble. Just like housing was a small percentage of the debt buildup to the 2008 crisis, auto loans are a small percentage of the post-2008 debt buildup. But both asset classes had fraud and subprime lending as an underpinning. And this time, all it has to do is prick the bubble. And boom, everything falls apart. And we're starting to see it in different states. Connecticut, for example. The state of Connecticut has been hit hard by the double whammy of deteriorating local economy, coupled with a plunge in hedge fund profits. And this is leading to a collapse in tax revenue, which means that the economy is doing poorly. And these companies are moving out of the state because they're looking for better tax breaks and things like that. So what's happening right now in Connecticut is that the latest figures show that the tax revenue from the state's top 100 highest paying taxpayers declined by 45% from 2015 to 2016. The drop adds up to $200 million revenue loss for Connecticut. Right now, there's a $2 billion budget gap estimated for next year. And Connecticut is not the only state. This is going to be in most of the states because what's happening is the local economies, the economies are in each one of these states, they're declining. Yes, there are certain areas where they're still doing well, but when this comes down, it's going to affect everyone. Go back to 2008. There were areas like Miami, for instance. Well, that was hit last in the real estate market. Business was booming there. Everyone was driving fancy cars, cranes everywhere. At the same time, up in New York, New Jersey, things were getting hit pretty darn hard up there. Layoffs were beginning, and Miami didn't see anything until months later. This is going to happen once again. Now, very interestingly, Goldman Sachs, as we know, is part of the central banking system, the deep state, but they've been sending out warnings about an imminent market correction, and they've been putting this out almost daily right now. And this is coming from cross-asset strategist Ian Wright, warned that last time correlations were this low was just before the financial crisis. And we can see that individuals inside of Goldman are looking at this and they're saying something is going on right now, and it looks like the clock is ticking right now and ticking down because the tax reforms which Wall Street is expecting, well, there's only 39 days before August, and guess what happens at that point? Congress, well, they leave. They go on vacation. They don't come back until after Labor Day. And remember, the budget only goes up to the end of September. We have the debt ceiling crisis coming up, and we're approaching that very, very quickly. So we're going to have a lot of things happen as we move into the summer months and especially the fall months where things start to really fall apart. Now, Bill Blain from Mint is looking at the situation in Europe, and he's finding that there's something wrong with what is going on with the ECB, with the EU. And he says the European sovereigns, they're going to start issuing long bonds again. A French 30 years in the works. Italy and Belgium are both looking, while other rumors say that the SF might be in the frame. Long-dated, low-yield bonds make great sense when inflationary expectations are low into infinity, and you expect the new normal of low rates in perpetuity to hold forever. Now, as he puts it, if the global economy is so rosy, why is the Eurobond market going long? Whatever happened to expectations Europe was going to grow again? Something is happening and we don't know what it is. He says, I'm worried. Too many people think things look too good. And I think what's happening right now is they're convincing everyone that Europe, well, they've recovered and everything is fine in Europe. And we know throughout Europe, it is a complete disaster. Many of the countries are in a huge amount of debt. There's a very high unemployment in many of the countries there because the central bank stepped in where all these countries were having trouble, saying, listen, we'll give you more debt if you impose or implement austerity on the people. And they continually did this, and unemployment rates went up, and people are now suffering. And when we look at the entire situation, they all use the same type of calculations like the United States does when it comes to unemployment, when it comes to inflation, when it comes to handing out statistics. They're doing the same exact thing. Now, out in Greece, they're telling us that everything is once again fine because the government is implementing austerity, they're taking on more debt, and they're just saying, okay, these people haven't been on an interview or anything like that, so the unemployment rate is going down, even though there are more and more people still looking for jobs. Remember, the unemployment rate, when it's at 25% or 28%, does it really make a difference at this point? There are so many people out of work. It doesn't mean that things just got better. It means they're recalculating and trying to make it look better. And as the country continually takes on more debt, it just gets worse and worse. And this is what we're seeing. Now, the Fed, they are looking to raise rates in June. And we can hear a lot of the Fed officials are out there saying that, yes, we're going to be raising the rates. We're going to be bringing them up. And it looks like they just got another signal where they can raise the rates. Now, remember, the first quarter, that was just a fluke. Really doesn't matter. Let's look to the future because things are just going to get a lot better. And the producer price index, which measures inflation at the wholesale level for goods and services, well, that has moved up and it's jumped to 2.5% in April from a year ago. Now, this is the steepest increase since February of 2012, blowing past the consensus expectations of 2.2%, which the Fed looks at and says, okay, we've reached the inflation rate we wanted. So now they can raise interest rates. And it looks like they're preparing to do this. Now, will they do this in June? We'll have to wait and see. But we know one thing for sure is they are preparing and they are ready to bring the system down. And all they need to do is bring the rates up to a certain point until they trigger a collapse scenario. Then they're going to back off. They just want to trigger it because if they go too far, they will be blamed for it. Just like if we go back to prior to 2008, they raised the rates, and as they were raising it, out in California, people were leaving their homes, they were leaving their stuff in their homes, and they weren't looking back. They triggered it at that point. They knew what they were doing. And then as they triggered it, they started to reverse it. But it was too late because the dominoes were falling already. And they knew that this was going to happen. And they knew they were going to have to keep interest rates very, very low after the crisis of 2008. And here we are in 2017. And they know exactly what they need to do to trigger a complete collapse. Now, at the same time, you have to remember, Trump is doing the same exact thing. And people are like, well, what do you mean he's trying to collapse the economy? Remember, he doesn't have the tools that the central bank has. So he needs to do something completely different. And that is to do exactly what they have done in the past. Blow the bubbles up until you pop them. Spend as much as you can. Think about your household. If you wanted to destroy your household, what do? You spend like crazy. You take those credit cards, you run them up to the max, and you keep doing it. You buy another car, lease it, You keep going until the whole thing completely collapses. This is exactly what he's doing. These are the tools that he is using. The central bank has the ability to create currency. The central bank has the ability to purchase toxic real estate. The central bank has the ability to raise and lower rates. The central bank has the trading desk in the basement of the Fed where they're trading stocks and stuff. And we know from past reports that, yes, central banks around the world, they are buying stocks of corporations. So they all have different tools to use to bring the system down. And right now, the Fed is going to say all their indicators are lining up and we can raise the rates because the first quarter was just an anomaly. Everything is still on track. And all they're going to do is raise it just enough to trigger the collapse. Now, Trump is trying to spend and do as much as he possibly can to blow these bubbles up and have them pop. And the reason why he's doing this, because this is exactly what the central bank has been doing. This is what past presidents have been doing. This is what Congress has been doing. So he's just going along with them, showing them, look, let's just keep spending. Let's keep doing what you're saying because this is how it works. And he's doing it in a way where he's going to push it very hard to pop these bubbles very, very soon. And this is why everyone needs to be ready for what is coming. And remember, when this system comes down, things are going to change dramatically. And we're going to go through different periods. And it's going to be rough for many people. And this is why we've been talking about getting prepared for such a long time. Because we knew that this storm was going to hit. And the storm is approaching. It's almost on top of us. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.